Welcome to Show Me the Money with Michael.derk. Show Me the Money is a podcast that is bringing in industry leaders in the commercial real estate sector that are either on the financing side, the development side, the acquisition side, disposition, brokers, investors, bankers, management companies, everyone that's in and out of the business and all facets of the trade, so that hopefully you can benefit if you're looking to grow your business, start your business, or maybe transition into something else. All right. Good afternoon, everyone. This is Michael.derk for another episode of Show Me the Money. We have a guest today by the name of Mr. Jack Cohen. Jack and I have known each other for well over 20 years now. Jack, welcome to the show, and thank you for being here.
Michael, thank you. I appreciate the opportunity to chat.
Thank you. Typically, I'm a little bit more dressed up, but today is a little bit more of a casual day. And
Me too.
Good. Go Ducks. So Mr. Cohen has more than 43 years of experience as a leader, manager, originator, and administrator across a diverse portfolio of career initiatives, primarily in commercial real estate. He currently is a managing director at Arrowmark Partners and serves as head of strategy for Saluda Grade. Mr. Cohen began his career with Cohen Financial in 1981 as a loan originator before becoming CEO, a title he held for 25 years, during which he recapitalized the firm 6 times between 1998 and 2013. His professional affiliations include serving as association president of Chartered Realty Investor and the Commercial Real Estate Finance Council, CREFC, being a member of the Commercial Real Estate Finance Multifamily Board of Governors, and sitting on big board at the Mortgage Bankers Association. His honors include the CREFC Founders Award for lifetime contributions to commercial real estate securitization and the MBA Combog Award recognizing borrower satisfaction efforts. After leaving Cohen Financial, Mr. Cohen founded Dark Knight Ventures, a personal holding company where he mentors executives, consults on strategic initiatives, and invests in operating businesses. He has held leadership roles at Sherlaw's Group as a small business enterprise coach, at 3650 REIT as a managing director, and at Strong Hill Capital as president and chief innovation officer. Additionally, he has taught leadership, career development, and men's college, the University of Denver, in conjunction with the Urban Land Institute, the University of Wisconsin, and the University of Colorado Boulder. Mr. Cohen authored his book, Freedom Frameworks, which provides tools for young professionals ages 25 to 35 to achieve career success on their own terms. Personally, he is an avid pilot with an airline transport pilot license and 2 single pilot type ratings for light jets, a second-degree black belt in Tumiki-styled Aikido, a New Age certified scuba diver, and an active outdoor enthusiast. Well, Jack, I'm definitely not going to take you on in a karate bout, but again, welcome to the show. Thank you for being here.
Thank you for the kind introduction.
Forever. I remember many, many moons ago, you recruited me to potentially come work for you. Maybe it was good, maybe it was bad, but long story short, I'm thankful to have you as a friend,
thank you,
colleague, and I'm very happy for all your success and coming at us live from Aspen, Colorado. I appreciate you taking the time to talk to all the listeners. Kind of jumping right into it, Jack, as far as the market of what you're seeing right now, from a 500-foot level above sea, effectively where you are in the mountains right now. If you could tell us a little bit about, the end of last year and what you're seeing currently right now. I know you talk to a lot of people as far as the investor pool, being an owner yourself as a principal, and then maybe from the finance aspect too. If you can kind of give us a quick overview of what you're seeing currently and maybe where the opportunities are today.
Well, Michael, it's obviously an interesting topic, and I'm not really sure where to jump in, but I guess I would start with recent. Just recently came from CREFC, and it was still astounding to me on a couple of points. One is it appears to me that too much of the capital is actually running the same playbook, and there isn't a lot of innovation. The other thing that kind of dovetails to your question about the end of 2024 is I just think the last couple of years have been about denial. You know, we all learned a long time ago that wishing and hoping was not an investment strategy. And the reality is that too many people in our space, owners of real estate, paid lip service to having a business plan to create value. Instead, what happened is they just grabbed an asset and hoped interest rates and cap rates would come down in a short order, and they would flip the property and make a bunch of money and call themselves self-proclaimed masters of the universe. The reality is that it's just not that easy. And I think January 2025, people are finally trying to accept that treasuries will stay plus or minus in the fours. So if you believe, let's just say 3.5 to 4.5 as 10-year treasuries, even though people aren't borrowing 10-year right now, I'm going to come to that in a second. I think that you're looking at a line of scrimmage for financing first mortgage in the 5.5 to 6.5% rate. Now, having said that, there is a lot of money chasing not a lot of transactions. And I think that you'll see two things in 25 that you didn't see in 2024 or even 23. One is you're going to see co-conspiracy among platforms where lending institutions team up, equity institutions team up, and they work together with other platforms in their co-conspiracy, their core competence. So, give you an example. At Arrowmark, we have a dozen or so separately managed accounts with life companies. A lot of our life companies really have real estate departments. They don't really need us, but for a life company that's average size loan is $75 million, if they're looking for $1 to $10 million loans, they don't want to build an infrastructure for that. So there's an example of an insurance company that people see their commercials on Saturday and Sunday all the time, looking to co-conspire with another platform. I think the other thing you're going to see is spread compression. So while I think the line of scrimmage is 200 basis points over treasuries, we've seen spreads go below 150 for multifamily, industrial, low leverage, or a deal for Michael.derk, right? I like Michael, therefore I'll do better. But a hotel deal, retail deal, a deal for Jack Cohen, I don't like him as much. That might be 225 or 250. And I actually think you'll see some really an opportunity for hard competition to get business done based on spread compression as opposed to base interest rate compression, if any of that makes sense.
Yes, I couldn't agree more. We're actually literally a portfolio we quoted a couple months ago. This is a tier 4, 55%. It's a portfolio of apartments in Orange County. Total capital stack is 40 million, 3 assets. So not large, but not small. These spreads on these deals were around a 140, 145 spread just about 2.5 months ago. As of today, that same exact deal is a 119 spread through the agencies. Full term IO, 155, 55% on a tier 4 basis. If the borrower opted to do a buy down on this particular deal, we would be at a 0.93 spread. So that's tier 4, creme la creme. So it just goes up from there. But even in the multi world, to be over a 200 spread, it must be a pretty tough deal. Tertiary market, a lot of issues, or you're at way above the capital stack at 75 or 80. In most cases, right now, we're seeing spreads compress in a big way. I've gotten calls from at least 4 different lenders in the past week that said, "Listen, we're in the game. We need to be out there lending. Let us know where we need to be in order to win the business." Last year, this time, I never got those calls. It was kind of like, here's our best shot. If they take it, great. If they don't, that's great too. They were almost happy to lose deals last year. This year, I think, in the same respect, like you were saying, people are coming to reality this year. Sellers are going to meet the market in some form or fashion, whether they want to it or not. And I think it's, every deal we've underwritten in the last, say, 6 months, the cap rates and the interest rates are completely uncorrelated. The interest rates are well over the cap rates. It's negative leverage, and the sellers still feel that their property is worth what it was 2-3 years ago. And it's just clearly not. Like you said, the same thing. A Moody's economist spoke to us last week. They were at 4.5 to 5% on the 10-year. That's where we sit today. We'll be bumping along here and there, but I think between 5.5 and 6.5% is where rates are going to be. So obviously the cap rates need to correlate accordingly. So I
It's
couldn't,
it's
I couldn't agree more.
it's interesting. You made me think about something, and I think you've been around long enough to remember. In the '80s we had negative leverage, and we had really high interest rates, and it didn't stop anyone. I think
Right.
what's happened in the last couple of years is people confused value with price. Your
Yes.
seller your seller's value is whatever anyone would pay for it. And he got, I would, I'm apologizing to say, he got lazy and stupid because the borrow community confused value with price. You
Yes.
shouldn't buy a property based on affordability. You should buy a property because you have a view of intrinsic value. And so, what's different this time versus any other time in our career is there aren't any flaws in the marketplace in a macroeconomic scenario. We don't largely have weak borrowers. We don't have weak tenants. We don't have weak lending institutions. We don't have Russia or China or Asian flu or whatever it was through the
Right.
decades that created problems. What we
Yes.
have is we've overfinanced assets, and some of them are good assets, some are bad assets, and we've overfinanced them for some good sponsors and some bad sponsors. I think if
Yes.
you have a good asset and a good sponsor, capital will find you and you'll reconstruct the capital stack accordingly. If you suck and aren't any good at what you do or have a shitty asset, it's going to be on the investing community to make a distinction. Do I want a good deal that michael.derk is showing, or do I want a shitty deal that Jack Cohen's showing? And the lending community has to own the judgment that I know the difference between a skilled operator, skilled sponsor, and a has-been or a wannabe.
Yes. Jack, I couldn't agree more. And we've done so much bridge execution over the last 12 months. It's really the only world that's been active, because conventional financing at true debt coverage, at true interest rates, I mean, you're putting 60, 70% down. It doesn't make sense. So people who are active are actually buying deals, and those buyers are going to have to be experienced. They're going to have to know how to execute in that market, that product type, and have a clear, concise exit strategy. And the exit strategy can't be a pro forma of lower interest rates. That's the thing, the misnomer that I see in the market. A lot of people are just betting, well, rates are going to come down, rates are going to come down. We've been hearing that for 2 years, and rates haven't come down. Rates have gone straight up, especially since the Fed has dropped their rates. And I don't foresee the Fed jumping in here to make any drastic correction. They're controlling the Fed funds rate. They're not controlling treasuries. The
Right.
government artificially bought treasuries at $90 billion a month, right, during COVID, and artificially inflated the values of real estate, especially real estate, a lot of asset prices. And now, it's just going to come down to the true operators. Everyone was just doing an equity trade and making tons of money on just selling equity because they were the smartest guy in the room with low interest rates. Today, it's a different, where the rubber hits the road, and it's going to come down to true operators who can actually operate these properties, not just get rich quick overnight because of low rates.
I agree with you, but I think you're glossing over one important thing. Um, I think that even the best of us can't really create value in 2 years or less. This
Correct.
idea that we're going to borrow 24 months with 2 1-year extensions, oh, okay, if you make me, I'll do a 3-year deal with a 311. This is where private equity has really ruined the marketplace for commercial real estate. When God created holding real estate, he created two things that everyone ignored: amortization on mortgages, what a gift from the gods, and two is the idea that you would hold an asset for 7, 10, 12 years, refinance it, take money out, and
Tax free.
generational, right, and generation wealth passed to second and third generation. But
Yes.
it's really kind of funny because CMBS, which is a monitor of nothing, created a product of late because the borrowing community wanted 5-year capital. Interestingly enough, this came up at CREF-C. Do you know that historically, the product, as you know, was 10-year product?
Yes.
Historically, a nominal percent of those 10-year borrowers ever asked for an extension. Do you know today in CMBS land, 5-year money, More than a third of all borrowers are asking for an extension. Oh,
Oh,
really? Why? Maybe because they didn't have enough time. So I actually think the answer to the final exam is not just a sponsor who knows what he's doing, executing on a plan that's well thought out, but longer dated, longer duration capital supporting it. And right now, the problem with the bridge world is it's a leveraged lender game. It's almost a Ponzi scheme because like I'm old enough to remember we did construction loans if they were covered by a life company with a takeout. And
yeah,
then all of a sudden you could do uncovered construction loans, but people underwrote them based on what a takeout would be for life companies as well as what equity would be. Fast
right,
forward decade after decade after decade, and people are doing bridge to bridge. I underwrote this thing at a 5 debt yield. Oops, I'm going to find somebody else who'll do this at a 4.9 debt yield so I can get out of my shitty deal. And that game has to stop. And the borrowing community is can't help themselves. You know, if somebody
right,
gives them high leverage, low interest rate, lots of money, they take it. And you know what? Shame on them.
right.
That's why they have the capital stacks that are underwater today. And that is a fix that has to happen.
Yes. And I couldn't agree more. And I'll tell you how it's going to happen. It's going to happen one way. It's not because of the greed factor that everyone in the market wants to keep getting rich and kicking the can. The regulators are going to come in. I've spoken to several executives at some large institutions I cannot name over the last couple of weeks, and the regulators are in there fast and furious. So anything that's going to be rolling in the next 12 months, either coming due or rolling to an adjustable, these loans have to be, I guess, classified and put money aside as a reserve. So those reserve factors are going to be hitting the large lenders, regional banks, anyone. So most lenders today on that side of the business are looking for liquidity to be able to offset the loan. So if they give you a 60% loan, they want 10 to 20%. So they're only giving you a 40, 50% loan at the end of the day because they're lending your own money at a higher rate.
Correct.
That's a smart business plan from the bank's aspect, but in the same respect, not everyone has those deposits to put together, and not everyone has 50% plus the deposits to put down. So that's why the market's been so quiet as of late. But right now, I think the sellers who have this debt coming due, instead of throwing the keys back to the lenders, I think that they're going to have to meet the market on pricing and realize that their equity is just not there that they perceived because their pro forma was lower rates, like you said, and it's
Right.
not. Yeah,
Yeah, look, going forward, and this will erode again, but going forward, people have to create value based on NOI. And that's a tough nut to crack right now with rents, either flat or coming down in certain marketplaces.
yes,
Insurance, the cost of insurance, if you can find it.
it's out of
Real
control.
estate taxes, obviously, in some markets like Chicago, where it's opaque, they're high. And I also view in markets like Chicago or San Francisco, I think security costs are an issue. So eroding NOI in a marketplace with interest rates higher than anyone thought and cap rates not yet coming down means a good guy with a good deal needs to hang on for another 7 or 10 or 12 years to make some money on the asset. And if he can't do it, he's got to take his loss and move on, because you and I would go in and buy that asset, hold that asset for 7 to 12 years, have our capital structure structured for that, and we'd end up with a really nice asset that was cash flowing and created value for us.
Right. Well, the thing is, I think I've seen, Jack, and you probably agree with me here, but it's the real estate market and real estate almost, not almost, I think it became like a stock over, from
Correct.
COVID to 2022. Those 3 years, really people were trading it as a commodity. It's like boom, boom, boom. Just, oh, we'll sell it next month. Who cares? Whatever. If their deal isn't stabilized, we'll just sell it for 10 or 20% more than we just paid for it, or double escrowing it. And the hot potato game really got out of control versus the basic fundamentals of owning real estate, long-term investment, long-term appreciation, taking advantage of depreciation, operating it organically, moving tenants out, moving them to market, looking at the highest and best use of the asset and making sure you're capitalizing that for you, or if you have investors, for your investors as well. That got thrown under the playbook there, and people are just like, nope, we got to get rich quick today, and if it doesn't, it's a terrible deal and we got to blow it out. So we're getting back to the management here at M&M. They always talk about blocking and tackling, the basic
Right.
fundamentals of the game, right? And that's what we're getting down to right here, because most people are going to the get rich quick, unfortunately, just like in any business. As you know, Jack, you're so well versed in so many businesses that it's not there. It's just
Yeah,
not there.
and your case study, which isn't where you and I are spending time anyway, but your case study is office. Think about it, right? I am a little older than you, and I can remember, office buildings that had shell and core costs of plus or minus $50 a foot, and
Sure.
TI was $10. Right? We were at ULI a year or so ago, and you were looking at the problems of downtown LA, and God knows what shell and core was, but tenant improvement allowances were $185 a foot. When tenant improvement allowances exceeded by a multiple of the cost that it took to build actually the core of the building,
Right.
you're in trouble. And then add to it the fact that we didn't amortize those loans. Think about where the world would be today if tenants paid for their tenant improvements
Yes.
and if amortization was on the borrower's agenda. You would not have the office issue that you have today. And because capital was flowing freely, and because a lot of foreign capital wanted big loans on either coast, you have scenarios where we've overbuilt the product. I was talking to a developer that I've known since we were both in the business in Chicago. In suburban Chicago, the surviving developers are actually taking their office buildings down to the ground. They're creating land value. They'll hold it and repurpose it as industrial or multifamily. Why? Because the capital markets want it and the marketplace wants it.
Right.
Said differently, we probably in 50 markets need to take 10% of the market out in
Yes.
order to rebalance equilibrium.
Right.
And that was all. I've always said two things about real estate. One is you can't legislate against greed or stupidity. And we have led the league in both of those. And all real estate makes money. The only question is who owns it at the time. And that's where
Right.
we are today.
Yeah. And realistically, finding the highest and best use for that asset. In so many of these office buildings, unfortunately, I drive by and I saw some of maybe the younger people on my team or some of the brokers, and I'm like, realistically, the highest and best use for that property is to bulldoze it. And they're like, that's a beautiful office building. I go, I couldn't agree more, but it's not even worth what they built it for, and it's going to be 40 or 50% vacant. So you can't pay the bills on that kind of vacancy factor based on debt loads unless you're at own free and clear, which it doesn't make sense for real estate to be owned free and clear. But it's hard to see. It's hard to see like great real estate and how much blood, sweat, and tears went in to build these, operate them. Then all of a sudden it's like, boom, the record screeches. No longer is that a great asset to
Right.
own. And it's not just office. I mean, that's for some apartments, that's for some retail centers, some hotels, self-storage. I mean, it goes across the board. I think industrial is an anomaly that really is very solid in most markets because the demand is there for single tenant and especially multi-tenant. But everything else is on the chopping block if it's in the wrong location and you built it at the wrong time. Timing and location. Everyone talks about real estate. What's the most important things? Location, yeah, but timing is also, because the best, A plus core located assets can also get crushed in the worst of times.
Yeah, no
Jack,
question about it.
moving into when you were originating deals and the CEO of Cohen Financial, a very, very successful mortgage banking firm, what did you do to ensure your clients were protected, especially in times like this? What were you doing differently than most of the competitors, and how did you navigate the markets to make sure your client was protected?
You know, um, I joke I'm often wrong, but never in doubt. And so my wife likes to say that I'm an acquired taste. I can't tell you the amount of times I was correct and lost a piece of business because of it, right? And so I've always felt our job is to do a handful of things. One is to really have a view that we agree or disagree with the sponsor's business plan, that we have a view that the sponsor has the capability, the capacity, and the willingness to execute on that plan. And then you apply a capital structure. And one of the things my brother Bruce always said was take risk at the asset level or in the capital structure, not both. And so I was maybe arrogant, but intentionally of the mind that I was an advisor saying, look, based on your plan, my view is that you should do blank, and this is what the structure should be. The problem was the marketplace kind of diluted itself to an auction. When I started in the business, I felt we got paid to know where to hit. That this was a Hancock deal, or this was a Protective deal, or this was a Lincoln National deal, or this guy would be the syndicated equity in it, because I understood what the risks were. And I think that smart investors don't chase yield, they chase excess return on a risk adjusted basis. And they do that by identifying, assessing, mitigating, and pricing risk. And so the problem with that is we started losing business because no borrower wanted to be told what to do. Well, if you're so smart, why aren't you the borrower? And they're not wrong, right? And so part of the expansion strategy was to not be a dictator or demagogue, but find Joel and Steve in Chicago, Jonathan and Michael in San Francisco, Nick in Texas. You know, I've been fortunate to have really good originators, monumental pains in the ass, all of them, but good originators in their own right. And what I wanted them to do is to be opinionated. And if Michael Joseph's opinion was it was really about the brick and mortar, or Jonathan's was it was about the sponsor and his capacity, who am I to judge?
Right.
And now how can we optimize the journey of our sponsor? And that's how we augmented. Obviously, scale had something to do with it. The combination between myself as a service provider and my brother Bruce was the principal side of the business. That business was spun out to be Rightwood Capital, and then it was Aries Real Estate business. So we in the 90s had a different view. Our view was we were going to be a principal, an agent, and an advisor. And then when the world came to the end in the great financial crisis, it was the servicing platform that saved me. I mean, we ended up with a $35 billion servicing platform, but that was because in good times I was plowing money into that platform, people, processes, technologies, and things.
Right.
So I guess, you know, you yourself as an intermediary have to have a view of the brick and mortar markets and the sponsors that make them, and a
Yes.
view of the capital markets and the capital institutions that make them. And
Right.
those market dynamics kind of don't make us um, forecasters, they make us opportunists, right? Where's the arbitrage? Is
Right.
capital easy or hard? Is the marketplace clean or a mess? Is the sponsor really unique or just a pain in the ass hanger on? And I really think the best of us are multilingual, right? I've always had a belief that in our world there are three cycles that we're watching, right? You talked about it before, right? There's the economy, there are the property markets, there are the capital markets.
Yes.
When those sine waves come together is opportunity. When they diverge is risk,
Right.
right? And
Absolutely.
I had a professor in college who once said, "Look, in good times, real estate floats to weak hands, but the good news is, in bad times, it finds its way back to strong hands." And that's what's really going on. Like, if
Exactly.
you know, there's always a great opportunity in our business.
There is. There's all facets of it. And, talking to clients, kind of going back to the core of the question, how are you really looking out for their best interest? And I think the fact of the matter is making sure we're getting capital to align with their expectations. And most importantly, telling them sometimes that there isn't capital in alignment with their expectations. When they bring you on a four cap, multifamily deal with little to no upside, with the decreasing NOI that you just talked about because of all those factors, right? Every expense line is going through the roof. In income lines, best case, are flat across the board. So we have NOIs going down, interest rates up through the roof, insurance, all these variables, and now we're going to see an increase of supply this year, values are going down. So it's a matter of aligning a business plan that correlates with that capital stack that will obviously allow them to be successful in years to come, not months to come, not days to come, but years to come, to make sure that they have the ability to execute, to make sure that that exit plan is there, not just one, two, maybe three different exit strategies, and not just tied to interest rates. So
Better said than I did. I appreciate it. Question to you on an extension on that. A year or so ago, I was in Texas with one of the guys at Arrowmark, and we were talking to sponsors. And I didn't know any of the sponsors. They were all big shots that my originator was trying to secure. And one after another had dozens of projects on construction loans. And I walked out of each meeting going, I wouldn't want to be in their shoes right now. But
right.
this probably was fourth quarter of maybe 23. And you could make the argument in Texas that once those properties come online, we're not going to have any new product coming out. Do you have a view in particular markets that there will be a supply and demand imbalance, whether it's Southern California or Texas in particular, where there's more opportunity, there's less opportunity for the next development deal?
Yes, absolutely. There's a disconnect. Like Phoenix, for instance, right now, Nashville, where I'm currently reside right now, there's a huge imbalance, especially like on the multifamily front. There's been a huge oversupply, overbuilding across the board. Texas, same thing. It will eventually catch up because the construction loans and the amount of construction coming out of the ground in the last 12 to 24 months has been pretty light. But right now, as everything is coming right now to fruition, like in Nashville for Class A apartments, on average, you're 2 to 3 months of free rent. So when you look at that on an effective basis, people are like, oh, most people are like, oh, well, then 2, 3 months, that's not so bad. I'm like, well, you look at it on an effective basis and it doesn't work. These projects, the cost to build these things and the income that you're going to be at an NOI basis and the time it takes to lease up, the carrying costs, it's massive. And that's why I see that coming. Like you talked earlier, Jack, on a bridge to bridge. Sure, they can keep kicking the can, but eventually these regulators are going to be like, okay, we're not going to keep kicking this can. Now you're into the, vulture funds that are giving you rates at 11 to 15%. I mean, I had a client looking for a second trust deed a couple weeks ago that was getting quoted between 15 to 20%. So either people are going to take that ultimate risk before throwing the keys back, or they're going to have to right size these deals. And that's where joint ventures and partnerships are going to be very accretive for people to be able to come in, right size these. And the main sponsor that's going to be there either hands those keys back or has to give up a large share of a property to be able to get to an exit strategy that makes sense. Because the takeout loans at 5% are not there. It's just
Right.
not there. It's 6 to 7. And so that's going to correlate to an extra 20% of equity, which in most cases is all the equity in the deal. And so on non-recourse basis, I think a lot of the debt funds and a lot of these construction regional banks are going to really feel the pain because, again, it all comes down to exit. And I know I'm keep repeating myself on that, but it's either there or it's not. So that's kind of it in a nutshell. Moving on, Jack, you've mentored so many people over your career. What are some of the pieces of advice? We have a lot of people who are high executives to middle level to brand new people considering to get into real estate. What advice would you give to someone maybe starting out in their career or kind of mid-level today?
So thank you for asking. I have a view that there's only 3 things you have to do to be successful in any career, but you have to do it daily. You have to acquire skills, accumulate experiences, and develop relationships. So I think the professional that you're talking about, whether they're young, out of school, late 20s, early 30s, or late 40s, early 50s, trying to figure out what they want the latter part of their career to be. Your most valuable asset is you. If you think about all the things we've been talking about as creating an income stream that we capitalize, what would you capitalize your earning power at? And think about that valuable asset. And so that young person who gets a job at $60,000 and is whining that their friend is at 66. And I say, I don't really care where you are at 23. The real trick is, where are you at 30? And if you're at 300 grand or move to a half a million or even more, take whatever cap rate you want. What was your growth of your self-worth in that period of time? And so in order to do that, you got to invest in yourself. You got to acquire skills, accumulate experiences, develop relationships. I think the single most important catalyst to my career was industry associations and networking. And I don't mean showing up at all the parties where, like PACs, like frat boys, we move from one party to the next and we're talking to the same people. Think about how long we have known one another. We may not talk for 6 months or a year, but when we come back, it's because of whatever went on decades ago in the trenches. We maintain relationships. And my favorite thing about the real estate business has been the people, even the ones I want to strangle. It's just such an interesting group of people. I joke, but it's true. When I got out of college, this is now 1980, 1981. The A students went to medical school. The B students went to this new thing called investment banking. And the C students couldn't get a job anywhere else, so they went into real estate. Like, none of us actually have any skill set, right? When you fast forward to these hotshots who go to these great institutions and they have real estate programs and MBAs and all that other crap, they have way more skill sets than we have. But they don't have a capacity to work. They don't have a capacity to play the long game. They don't seem to have a capacity to build relationships because they're so busy on Snapchat and Facebook and on whatever crap that's on their phone, they actually really forgot how to bond with another human being. I know that sounds just terrible as an old guy,
It's
but
the truth. That's the truth.
those are my views. Invest in yourself, acquire skills, accumulate experiences, and develop relationships, and just keep at it. Play the long game.
I love it. I couldn't agree more. And for me, starting out delivering newspapers when I was 6 years old and growing up in Buffalo, delivering it through the snow, and it builds grit. And I always talk to the younger brokers that start in the firm and whatnot, and younger people starting. I'm like, it's activity level and skill set. Just focus on those two things, constantly working harder than ever and just increasing your skill set, just like you said. Jack, outside of your professional life, you are a pilot, you're a black belt, right? I know that you're a very avid outdoorsman. Um, you know, how does that correlate into your professional life? How do you always find time to do it? Like in the height of not now being on the retired side, living in a beautiful place in Aspen and whatnot, but back in Chicago, back in the thick of everything at age, 35 to 40, where you're just like in it. Are you making the time for this, or are you like, no, I'm just constantly grinding it out? Because I think a lot of people, myself included, I'm like, you know what? I'm not going to work out for the next 3 days. I'm going to work from 8 a.m. until 8 p.m. And I am mentally just exhausted. Right. So how did
Well,
that go for you from someone who's been so successful and is retired, who's done it, you know?
Well, my wife would love to know that I'm retired, but I'm really not, and I have way too much on my plate because my eyes continue to be bigger than my stomach. But my view of this is a couple of things. Sherlock Holmes said the best rest is a change of problem. Do you remember Jimmy Connors, the tennis pro?
Oh
He
yeah.
was the first bad boy. He had a head coach by the name of Dr. James Lohr, and Lohr's view is high performance athletes are not overstressed; they're under recovered. So if you think of a sine wave, right? Pressure, 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 release, release, release. I believe the combination of those two little sound bites is that I needed different activities to take my mind off of what else I was doing, right? I needed to cross train and do things that weren't really on point. But Tamiki styled Aikido, as an example, is about conflict resolution. How much of your negotiation is really about negotiation as opposed to conflict resolution? right? Rock climbing is about functional incrementalism, right? It's about having an outcome that you seek, but not getting too caught up about what's in front of you or what's below you, but rather where you are today. And so
Right.
for me, I have been aggressive about cross training. And I have always believed people do business with interesting people. And if all you do is, bet on MGM or FanDuel, and you come home and watch YouTube videos, and during the day, you're responding to your client's needs, I would argue that you're really not developing texture to who you are as a professional. And so, yeah, I think it's discipline. It's making time. It's getting up early. I talk about this a little bit in the book. It's about knowing your biorhythms, right? I'm up early and I do more heavy thinking and strategy work in the morning. I work out in the morning and on the weekend. I'm not one of those people that can take it's lunchtime. I think I'll go work out. That doesn't work for me.
Right.
And so you have to know your biorhythms and be disciplined. And I'm a big believer in planning. Yeah, like everyone else, I use Outlook, but every week I move over to a paper notebook. It's called an uncalendar, where I can organize it any way I want, so I know when I'm working on my hobbies and when I'm working on my professional skills and when I am doing all the things that I want to try and accomplish in my life. So it's not easy. But yeah, I think it's all part of the grind, but it really depends on, do you have a committed view of an intended future that you're trying to achieve? If you don't, and you're marred in your current reality, then all of a sudden you start rationalizing based on the current reality. Well, I really can't change jobs because I can't afford a pay cut. I really can't change jobs because there's too much travel and I don't have time to do the research. Oh, I'm traveling a lot. I don't have time to work out. Oh, all of this is based on content. And all of us live our lives in daily content.
Right.
Wars are fought over content. But the key to life is understanding context. And the mother of all context is why we're doing something. And I had a view that I wanted to be Batman or James Bond, right? James Bond had a black belt, he could fly, he could scuba dive, he did all these cool things to save the world, right? Batman had no superpowers, but he had intellectual and economic resources that he used to create tools to affix to his utility belt in order to create human leverage to help others optimize their journey. Right? Those were metaphors for me that caused me to want to be really aggressive about skill acquisition.
Got it. Well, that's awesome, Jack. And obviously, you've been so successful based on what you just said, and getting to the ultimate exit strategy to the other side, and not having to be in the grind every day. Hopefully, that's helped a lot of the listeners on the show, because I think that's critical. A lot of people get stuck in ruts, start making excuses, but I think the key, what I do myself, is wake up and stop making excuses, and look in the mirror and say, let's go. It's go time, and it's investing in yourself, just like you said earlier. One of the last points here, Jack. Everyone, this is my favorite part of the show. Everyone has their highs and lows in their life or career. I just want you to pick one of those highs, and more importantly, what's that low, and how did you come back from that?
Wow. We get to do therapy. Um, I would say two lows. One is, I joke, I've made three great mistakes in my life, one of which was going to work for my father. My father was a consummate entrepreneur, did really well. He created Cohen Financial. But my brother at one point in time, I had two brothers and myself back in the business, and we had family business drama. One could argue that I experienced betrayal. I'll say that my brother may not think that be the case, and this goes back a lot of years, and we're past all that stuff. But that was really hard for me to overcome. The other part of that, which is kind of an extension of this, is twice as a lender and once as an investor, I got caught in a fraud scenario. And I talk about it briefly in the book, but my wife and I did a junior year abroad back in 2015 and 16, and we moved to London, and I did some consulting for a small business enterprise consulting firm called Sherlaws, and the guy who founded it was brilliant, created great intellectual property. He was an absolute crook. And me and the two other shareholders sued him in the UK courts and won a £2 million judgment for
Wow.
fraud. I've been
Okay.
chasing them. I've been chasing them all over the globe for 7 years.
Really?
So that's kind of a fraud thing. But I also, as a lender at Strong Hill, we did a lot of great loans. We had a really great hit ratio for success and repayment. We had a scenario, kind of national, foreign national, who was absolutely a total crook, and it was fraudulent, and we had to bring, like police involved in it. And I took both of those really hard, and one of the things I learned is no matter what you do in due diligence, if somebody's a lying cheat that's going to screw you, there isn't anything you can handle from that.
Right.
What's a success I'm proud of besides the obvious of my four children? I've really enjoyed working on teams with others. The thing that I miss today, I'm blessed to have a myriad, a nice mosaic, a portfolio of activities that keep me active. But I miss being on a team with others trying to take a hill. And during my leadership at Cohen Financial, I was there almost 35 years, we recapitalized that business 6 times. And what that really meant is a step variable where investors came into the business and had an opportunity to come out of the business. And yet I kind of still stayed and kind of continued to move us along. And if you think about one of the problems entrepreneurs have, exit, you talked about it in a deal, is what is exit? And is your exit time frame similar or flexible enough to somebody else? If you're building a successful business, and a lot of people in the real estate business, because we make so much money, run what I would call lifestyle businesses. And as lifestyle businesses, they're not really trying to preserve and grow the value of a shareholder's position because they're the shareholder. Right. So
Right.
they think about it as, yeah, the country club's on my company and the car is on my company and I'm making all this money and I'm reducing my taxes. All well and good. I have no issue with that. But if you're going to build a business that creates enterprise value, and if you have a vision that outlives of short-term duration, you need to recycle capital. I'm very proud of the 6 recapitalizations of Cohen Financial. I'm very proud of all the people I was associated with who are in different places in the industry who will remember fondly their time at Cohen Financial. There's nothing that's been a greater high for me to offset betrayal and fraud as a low than those two scenarios.
Got it. That's priceless information, and thank you for sharing that. A lot of people that are on the show, talk about these highs and lows, and it hits home in a lot of times. And a lot of people just look at someone like yourself, Jack, and it's like, oh, it's just been easy street and just blah blah blah. But in reality, the grind, the blood, sweat, and tears to get to where you are today, it takes a lot of work and a lot of humility too to get to that point. So
I,
I
I, I appreciate it. I really do think a lot of us, yourself included, have had success, but we enjoy the journey more than the destination. I've never met anyone who has a good answer as to what the definition of success is or how much money is enough. And so the for me, I'm addicted to the journey, and I prefer the journey with other co-conspirators than myself. And I feel very fortunate. I don't feel like it's a grind. Right now, I'm fighting like my schedule and other people's cadence, but as I said, I'm really blessed and really lucky to have the opportunity that I have. And my dad was an active investor in real estate until he was 93. I'm a pup at 67, so I got another 27 years because I'm competitive and want to last one more year than him.
right.
I'm curious. Curious George was always one of my favorite characters as a child growing up, And I'm always looking on the other side of the fence saying, oh, that would be cool. How do we do that?
Right. I couldn't, yeah, and the dynamics of real estate are so great. I woke up this morning at, I don't know, 6 o'clock a.m. and I had an email in my inbox an hour earlier at 5 a.m. I'm like, wow, I usually beat most of my clients up to the emails. And he's 92 and he emailed me from Antarctica, out there on a journey hiking and doing some, expeditions out in Antarctica at, 92, 93 years old. And I just sat there and I looked at him like, wow, this is awesome. And the nice thing is real estate you can do forever. It's kind of like the game of golf. I've golfed pretty much my whole life since I was, I don't know, 4 or 5 years old. My dad got me started. And, you can do it obviously with, health wise, keeping you going. But it's so nice to keep your brain sharp and keep things, moving forward and to help people in this business and, help yourself as well all around. It's just a great business to be in. And obviously I, very thankful to have the opportunities to work with someone like yourself for many years. And Jack, I just want to say thank you so much for being on the show. It
My
truly was.
pleasure.
It was an honor to have you, and thank you for taking time to come on and speak to all of our listeners. And that's it. So
Thank you very
everyone,
much.
thank you, Jack. Everyone have a great day, and thank you for listening. Take care.